The London silver market is reportedly experiencing almost complete lack of liquidity, according to Bloomberg, a prominent U.S. financial news outlet. In order to keep their positions intact, traders who are short on actual silver are rushing to acquire it, frequently at exorbitant borrowing rates. Currently, there is a lack of liquidity. There has never been anything like what we are witnessing in silver. Greenland Investment Management's chief investment officer, Anant Jatia, made the statement. Now, three of the largest investment management firms involved in this trade, TD Securities, Greenland Investment Management, and JP Morgan, are all reporting the same thing. Therefore, it is safe to assume that the United States may be the final country holding silver after a worldwide shortage. And we will address that shortly. The examination of silver by Robert Kientz starts with a strong but basic hypothesis. Silver is the unsung hero of the industrial sector and a medium of exchange. Silver, unlike other commodities, has two distinct personalities. It is both a crucial industrial resource for contemporary technology and a precious metal that has stored wealth for generations. Silver is in high demand due to its one-of-a-kind function, which is unlike any other element. Silver, according to Kientz, is the most undervalued asset in the world market right now because of its dual use. He thinks that low nominal prices have made investors and politicians too comfortable to notice the impending dramatic revaluation caused by structural imbalances in the industrial and financial sectors. He stresses over and again how fundamentally limited silver's supply dynamics are. Silver is mined as a byproduct of other metals, such as copper, zinc, and lead, and the world's mining output has leveled out. Because of this, the supply of silver cannot readily meet the increasing demand for it. When silver prices rise, miners can't just trigger the production of more silver. At the same time, its indispensable function in electric vehicles, solar panels, medical uses, and electronics is driving fast expansion in its industrial use. Kientz sees the current imbalance between supply and demand as an impending disaster that the market as a whole has not yet priced in. Then he makes a prediction. Like oil and uranium markets, silver could undergo a structural repricing in response to impending shortages. The increasing volatility of the physical silver market is another cornerstone of his prediction. Rising bullion premiums, delivery delays, and falling inventory in key exchanges are among of the indicators that Kientz uses to argue that the system is subtly tightening. According to him, investors will demand physical silver once the illusion of abundance generated by the extensive network of futures, ETFs, and derivatives is shattered. He predicts that a short squeeze will occur when the gap between the paper and actual markets widens, leading to a dramatic increase in prices due to a lack of supply. He predicts this might set silver off from its present undervaluation and launch it into a period of spectacular price discovery. Please subscribe to our channel and enable the bell symbol to receive timely updates before we continue to discuss this. Thank you for watching the video. There have been reports of a silver squeeze 2.0 in the silver market, and we will go through what is happening and the reports in the press now. As we enter the middle of the month, we had some very interesting events in the silver market, and that is what I will be discussing today. I have lots of charts and stuff for you guys. I should preface this by saying that the previous time we had a silver squeeze in the 2020s and 20s, the markets in the US managed to keep prices at 30. Lots of money was moving into exchange-traded funds. I was forthright in my assessment, saying that the silver in question is merely paper and that a genuine squeeze would not materialize until buyers removed it from circulation. The majority of the silver held by ETF investors is actually kept in the London market, or the UK, under the supervision of either the LBMA or that market itself. And other than that, it mainly simply sits in the warehouse and is swapped around. You can't experience a silver squeeze, a situation where there is insufficient physical silver, through a paper trade or contract. That is essentially what you do outside of the actual marketplaces. Indeed, it was the result. This is Silver Squeeze 2.0, as I had anticipated. When Silver Squeeze returns, it will be due to a physical squeeze I predicted several years ago. In the last 6 months or so, almost $200 billion was invested in the SLV Silver ETF, as I've mentioned on earlier broadcasts. After that, it burst in August, releasing a deluge of them. I mean, it's merely an investment in silver, which is why it always begins that way. In the United States, the process always begins with silver investors and generalists who have access to capital through a trading account or some other means, or a retirement account, probably with a brokerage like Schwab or E-Trade. Aiming to get exposure to the silver price, they intend to transfer those money in that direction. They could not be attempting to accept delivery. Furthermore, several of these ETFs do not allow delivery. Currently, we are experiencing a tightening of the London market. There is no free-floating silver left, Robert Gottlieb said in a piece published in the Jerusalem Post. So that you can understand what's happening, I will lead you through this article and a couple more before going over the statistics. Whispers of an impending silver squeeze have resounded through precious metal circles for years, the article continues. It seems the time has come, and now there will be repercussions all the way from Tokyo to London. There is basically no free-floating silver left, said Robert Gottlieb, an official at J.P. Morgan Bullion Bank. The metals market is buzzing with excitement after hearing that statement from a powerful insider. Lease rates skyrocket, causing short sellers to frown. The interest paid to borrow physical silver for delivery, known as silver leasing rates, has soared by 20 to 30%, far surpassing platinum's rates. The market is often quite plentiful, thus this is a really unusual sign of scarcity. According to a new piece of research in the J-Post regarding the present silver squeeze, the scarcity in London is but a taste of what can happen when the paper silver system starts to fall apart. On a side note, I've mentioned it on my channel, Twitter, and YouTube about how market experts from TD Securities went on national television to announce the start of Silver Squeeze 2.0, which would be a physical one. This is making its way into international media outlets and has already made it into mainstream news. Getting back to the quote from the article, according to the data reported by J-Post, both gold and silver have lately broken through important psychological levels, with prices breaking past the $4,000 and $50 thresholds respectively, indicating strong momentum. Returning to the market's technical and psychological levels, I will explain their operation again. Some people on various platforms have been criticizing Western market analysts like me for sticking with technical trade even though it doesn't affect the market. Furthermore, I will demonstrate why adhering to both technical and basic principles is essential. In my opinion, fundamentals will win out over technicals in due time. For the past 16 years, ever since I began penning articles about gold and silver for Seeking Alpha, which was syndicated across multiple mainstream publications, such as Yahoo Finance, NASDAQ MarketWatch, and others, I have maintained that position. While I was penning this, and it is significant, nevertheless, we will return to that shortly. If you can locate the print version of this article, you can see that the price of banning silver has increased to 12%. Additionally, the article recognizes the monetary aspect of the trade. Borrow fees for the iShares Silver Trust, SLV, a company I mentioned at the start of the film, are currently approaching 12%, and there are no shares left behind. The suffering is getting worse for individuals who bet on a decline in price. They're losing money as prices rise and paying exorbitant borrowing rates. There is a real squeeze on these shorts in the paper market, and that's going to trigger an explosion in the physical market as well. The demand for supply is still going strong. Short positions are being eroded by rising prices, and the noose is being tightened by a shortage of liquidity and, oh no, surging borrowing costs. You can see how these factors are changing the market in a linked JPOS article about ETF pressures and borrowing costs. If Gottlieb says there can be no free-floating silver, he is not chatting. The fact that almost all physically delivered silver might be leased or transferred as a result of being bound up in ETFs, industrial contracts, and other long-term obligations is reflected in this. This has been going on for a while and will continue to happen, as I've mentioned on my channel on multiple occasions. There is very little that is free and unfettered. The effects on international trade and delivery have been highlighted by one J-Post inquiry into the physical scarcity of silver. Next up, we have a story from J-Post. When a historic squeeze occurs, the United States ships silver bars to London. As prices of silver surge beyond $50 per ounce due to a historically tight market, the U.S. has sent bars to London. As reported on October 12th, just a few days ago, physical shortages and increasing premiums indicate extraordinary worldwide silver stress. The story states that a major physical shortage in London is causing the global silver market to experience an unprecedented crisis. In order to stabilize supply, U.S. silver bars are being shipped across the Atlantic. This is only the second occasion in history that the price of a precious metal has soared to levels where it is measured against $50 per ounce. The notorious Hunt Brothers squeeze from 1980 comes to mind. London is impacted by a liquidity crisis. It had previously struck London, incidentally, when rumors circulated that the city lacked sufficient physical silver, some 6 or 8 months ago, or perhaps a year ago. The precise moment is clear in my memory. In addition, I have been sharing the OBMH website chart showing the steadily declining silver holdings. Since not all commitments are disclosed, we were unaware of the amount already committed to ETFs and other private contracts on that chart. Free floating, however, was shrinking, as can be seen by comparing that figure with the one about London inventories and ETFs. In the past 2 or 3 years, I've done that probably 30 or 40 times. It has finally hit. Now that it's drawn and more is floating around in the ETFs, we can see what happened. There is now a critical chasm between the price of claimed silver and free-floating silver on the London market. The London silver market is reportedly experiencing almost complete lack of liquidity, according to Bloomberg, a prominent U.S. financial news outlet. In order to keep their positions intact, traders who are short on actual silver are rushing to acquire it, frequently at exorbitant borrowing rates. According to Kientz, the global debt cycle and the declining legitimacy of fiat currencies are the two main factors that will determine silver's long-term strength from a macroeconomic perspective. He thinks people will lose faith in paper currency as long as inflation stays high and central banks keep printing more money to prop up their over-indebted economies. This change will be good for gold, but silver, which has monetary and industrial uses, may do better percentage-wise. Silver, he says, is the poor man's gold, a way in for regular people who want to hedge against currency debasement. Silver is more than just an investment when troubled times arrive. In doing so, it provides a physical buffer against systemic instability and a means of financial autonomy. Even Keynes admits that silver is volatile, calling it a blessing and a curse. In both directions, silver's limited market size tends to amplify price swings. Therefore, long-term investors will benefit from being patient, even when corrections can be harsh. He warns that short-term speculative fluctuations, suppression of derivatives, and institutional manipulation could keep prices distorted for the time being. Instead, than seeing these changes as dangers to be avoided, he sees them as opportunities to accumulate silver before the world realizes how rare and important it is. I believe that the current period is characterized by monetary demand for silver, which is driving up its price. Consistent with what the report states, there has been a steady demand for investments, notwithstanding worries about Western debt and currency devaluation. The structural fall in London inventories and the availability of silver. Keep in mind that the trading of exchange-traded funds, ETFs, removes silver from the markets. Available silver has decreased by 75% in the past 6 years, going from more than 850 million ounces in 2019 to a meager 200 million ounces today. Golden Week saw a surge in Indian purchases, which caused demand to migrate from Hong Kong to London. This is par for the course given India's high demand for silver. The country's import limits on gold caused a shift toward silver, but the love trade between India and other countries involves both metals. China shares the same view. Around this time of year it takes place. That's why you experience cyclical pain. Gold and silver prices have risen because to strong physical demand in Asian and Indian markets, but we are also experiencing a constraint. Therefore, it is speeding up. That is why silver has rebounded and surpassed its prior all-time high, $50, before inflation was even considered. Even after accounting for inflation, we still haven't reached the peak, which is why I anticipate it to keep moving forward as well. Another factor is the possibility of UF tariffs on silver imports, which would increase supply uncertainty on a global scale. The remaining amount of metal in circulation has decreased to 200 million ounces, a 75% decrease from 2019, according to Bloomberg. Even ETFs are halting the addition of new capital. The domestic market is seeing a scarcity of real silver, according to Kotak Mahindra Asset Management, which is driving prices significantly higher than foreign benchmarks. Areas with higher premiums are becoming apparent, but for what reasons? Features of the local market for goods and services. The precious metals markets will eventually experience what I have predicted for years. Once physical squeezes and demand surges occur, the markets will separate into regional markets regarding premium pricing and physical deliveries, meaning that London, the COMEX, and the US will no longer have price control. Because various locations have different features, we are witnessing the US flybars going to London. The real price you pay will be dictated by two global centers, and there will be no more spot prices or premiums. That is currently evolving. China, India, and Dubai will take the lead in determining prices, moving east of the BRICS countries. As the story states, the London Bullion Market Association has stated that it is keeping a careful eye on the silver market's tightness. Price dislocations have reached levels never seen before. There have been major price and trade disruptions as a result of the strain. Spot prices in London are currently 3 yaws higher than futures in New York. For that reason, you will see what I'm about to tell you. If London's value is higher than the US's, scalpers will play the paper trade, exacerbating pricing issues and eventually leading to the separation and fading of the once congruent or together pricing model between London and New York. However, it's inevitable that these various regional marketplaces will eventually overshadow global physical trade. Consequently, spot prices will eventually be influenced by factors other than London and COMEX. Current and futures prices, as well as their degrees of correlation. Ought to mention that borrowing rates for overnight loans are over 100% of market value, which is higher than anything observed since the Hunt brothers squeeze of 1980. Since banks are no longer quoting, the bid-ask spread has increased from a few cents to more than 20 cents per ounce. The news has reported that multiple banks have stopped quoting. The quotations get exceedingly wide because banks don't want to quote each other, according to Robert Gottlieb, a former trader at JP Morgan. Why? This is due to the fact that the derivative markets and regional variations in demand and supply affect pricing differently. I understand. All right. For more, see that article. We shall proceed. Bloomberg has published an article. I won't unlock the premium edition just yet, but the following Bloomberg piece on Yahoo Finance is superior, and this one was early. I simply want to demonstrate that while the historic squeeze shocks the market, silver traders are rushing bars to London. Indeed, we will be sending them from the United States to the United Kingdom. Additionally, I would like to verify this with a reputable source. For a great breakdown of the topic, check out this post on Yahoo Finance. However, it will reveal that there are indications of the squeeze being eased. Therefore, the market is receiving some physical and short-term liquidity. The United States will begin to feel the pinch of silver as its physical stockpiles dwindle in London. Rest assured, this is only a stopgap measure. According to the article I'm reading to you today, there is a brief relief from some of these pressures. Not entirely, but noticeably lessened. And this relief will only grow as the United States of America's silver supply depletes, as we may be the last country with physical silver on hand. Even it doesn't tell you much because we don't have much either. As the pressure on the London market begins to ease, silver prices decline, according to Bloomberg. October 14th is the date. After reaching a new all-time high earlier on Tuesday, spot silver prices fell. The historically tight market in London has started to loosen up a bit, albeit supplies are still extremely low. Silver spot prices dropped 3.4% after reaching a new high of 53.55 per ounce in London on Tuesday. In January 1980, on a contract that was monitored by the Chicago Board of Trade and Hunt brothers, among others, it peaked at around that amount. Presently, it's approximately $1 higher. As a result of global anxiety over London's liquidity, silver has been in high demand, sending benchmark prices skyrocketing to near historic levels above New York. For some traders, this means booking transatlantic shipping slots for silver bars and shelling out big bucks for motor transport, which is usually designated for gold. In order to capitalize on the increased pricing in London, Just like I've been reporting for the past few months, the demand from exchange-traded funds, ETFs, has skyrocketed, and as a result, money is flowing into silver through these derivative contracts, which are ETFs. The reason behind this is that physical silver cannot be obtained by anyone who isn't an authorized participant, and these ETFs serve as a substitute for physical silver. Additionally, there are around 50,000 shares on the SOV and GLD. People in general do not have the right to redeem their assets. You also do not have redemption rights on the majority of ETPs and ETFs. Do you? It's rare. Plus, you'll still need a ton of stuff for the Sprott one. You must redeem the PSLV before they give you your money. Because physical silver is so difficult to procure, investments in this space are considered derivatives. Please continue reading. According to some dealers, these silver bars will begin arriving in the next few weeks, and the premium has already been significantly reduced due to arbitrage trading. About $1 separated the two. After a $3 spread, it's now on Tuesday. The spread versus COMEX has been widening on this chart since around this area. Then it leveled off, and now it's growing again as anticipation of silver bars arriving in mid-October grow. This is solely the arbitrage. The actual metal silver is not meant by this. If demand continues to rise, more bars will need to be sourced, which entirely relieves trade. And what will they do when the US market is no longer able to accommodate them? Anywhere else in the market where people are willing to sell for more money. Then, if that isn't sufficient, you must visit the mines. Another issue with the mines is that primary silver mines, which deal with silver, have not been growing. One of the most significant revaluations in the history of contemporary finance is about to happen in the silver market in the coming years. Purchase power will be steadily eroded as long as the world economy depends on increasing debt and monetary stimulus to maintain expansion. If governments are unable to control their spending, inflation will become an inherent part of the system, rather than a short-term issue. The global demand for physical assets will rise in this setting. Once written off as a waste product of industry, silver is about to make a comeback as a safe haven for investors. By the time you're in your late 20s, the fissures will be plainly visible. With the rapid growth of solar power, electric vehicles, and medical devices, the world's mining production isn't going to be able to meet industrial demand. Refineries will start to issue physical scarcity warnings as stocks fall to levels not seen in decades. The lack of actual metal backing massive derivatives. Contracts will be revealed when investors who previously trusted paper silver markets begin demanding delivery. The transition from paper to physical will be explosive, leading to skyrocketing premiums, a tightening of supply, and maybe prices surpassing prior highs in a couple of months. Leave a comment with your opinions, subscribe to the channel, and like if you thought this analysis was helpful. With your support, more individuals who should hear these important conversations will be able to do so.